The first half of 2025 has been nothing short of brutal for the US dollar, sending shockwaves through financial markets and boardrooms around the world. By July, the dollar had plunged 10.8%, its sharpest and most dramatic drop since 1973, when the collapse of the Bretton Woods system rewrote the rules of global finance. Now, the dollar's status as the world's reserve currency is under intense and unprecedented scrutiny, as nations and investors question its reliability. For decades, the dollar was the bedrock of global trade and finance, granting the US enormous influence, cheap borrowing, and a unique position at the heart of the world economy. But now, that privilege is being called into question, and the world is watching closely. This isn't just a number on a screen or a blip in the markets. The dollar's rapid decline has forced investors, multinational corporations, and even entire governments to rethink their faith in American economic leadership and stability. Unlike the 2008 financial crisis, today's fall is driven by a complex mix: aggressive US policies, ballooning national debt, and rapidly shifting geopolitics that are reshaping alliances and trade flows. The sheer speed and scale of the drop has shocked analysts and market veterans alike, signaling a deep and growing loss of confidence in the US economic outlook. The big question now, is this a temporary correction, or the beginning of a new volatile era for the dollar and the global financial system? The last time the dollar was this weak, the world faced oil shocks, soaring inflation, and economic turmoil. Today, uncertainty reigns again, but the stakes may be even higher. A weaker dollar means Americans pay more for imports, from everyday goods to critical resources, putting pressure on household budgets and businesses alike. Meanwhile, central banks worldwide are rethinking their reserves, diversifying away from the dollar and exploring alternatives like gold, the euro, and even digital currencies. The story of the dollar in 2025 is one of a superpower's currency at a crossroads. Its future uncertain, its dominance no longer guaranteed, and the world waiting to see what comes next. At the heart of the dollar's troubles are President Trump's economic policies, which have sent shockwaves through the global financial system and fundamentally altered America's economic relationships. The America First agenda imposed sweeping tariffs on China and the EU, aiming to cut the trade deficit and revive US manufacturing. These policies were designed to protect American jobs and industries, especially in sectors like steel and aluminum, and to encourage companies to bring production back to US soil. Instead, it triggered retaliatory tariffs from trading partners, disrupted global supply chains, and made the US a less reliable partner in international commerce. American exporters faced new barriers, and many businesses struggled to adapt to the sudden changes in trade flows. The world responded by forging new trade alliances, bypassing the US in key agreements, and accelerating efforts to reduce their dependence on the dollar. Once a fringe idea, de-dollarization is now a central goal for China, Russia, and even some US allies. These countries are actively seeking alternatives to the dollar for trade and reserves, reshaping the global financial landscape. Ironically, America's confrontational stance has pushed others to build a financial system less reliant on the greenback. New payment systems and currency swaps are being developed, and international trade is increasingly conducted in other currencies. Trump's open calls for a weaker dollar to boost exports broke with decades of strong dollar policy, unnerving investors and creating uncertainty in global markets. This shift signaled a dramatic departure from the stability that investors had come to expect from US leadership. Publicly advocating devaluation signaled a willingness to weaponize the currency, eroding trust in the dollar's stewardship. Investors began to question whether the US would continue to protect the value of its currency or use it as a tool for short-term gain. The result? US assets are less attractive, foreign capital is fleeing, and investors demand higher premiums to hold dollars. This capital flight puts additional pressure on the dollar and raises borrowing costs for American businesses and consumers. America First has proven to be a double-edged sword, hurting the dollar's global standing as much as it aimed to help at home. The very policies meant to strengthen the US economy have, in many ways, undermined the dollar's role as the world's reserve currency, leaving America to grapple with the unintended consequences. The Federal Reserve is under unprecedented pressure. Traditionally independent, the Fed now faces relentless demands from President Trump to slash interest rates. In early 2025, the Fed surprised markets with aggressive cuts, citing global slowdown and trade tensions, but many saw it as political capitulation, This perception has damaged the Fed's credibility. When rate decisions appear politically driven, confidence in the dollar erodes. Lower rates make U.S. assets less appealing, prompting investors to move capital elsewhere. The Fed is trapped cut rates and risk further dollar decline and inflation, or hold steady and face political backlash and possible recession. The loss of central bank independence is now a major liability for the dollar, fueling doubts about its long-term stability. Another blow to the dollar. America's surging government debt is making headlines once again, raising alarms among economists and investors alike. The scale of the problem is hard to ignore, as the numbers keep climbing higher. Recent massive spending bills, focused on infrastructure and social programs, have added trillions to the federal deficit, with no corresponding tax increases or significant spending cuts to offset the cost. This approach has fueled concerns about long-term fiscal sustainability. To cover these new obligations, the U.S. Treasury must now issue huge amounts of new bonds, flooding the market and putting upward pressure on interest rates as investors demand higher returns for greater risk. This surge in borrowing directly clashes with the Federal Reserve's efforts to keep rates low, creating a tug-of-war that injects even more uncertainty into already volatile bond markets. International investors, who were once eager and reliable buyers of U.S. debt, are now growing increasingly wary, questioning whether America's fiscal path is sustainable in the long run. The debt-to-GDP ratio is set to surpass even the highs seen after World War II. But unlike that era, the U.S. now faces the dual challenges of slower economic growth and an aging population, making it harder to grow out of debt. Credit agencies have started to issue stern warnings about possible downgrades to America's credit rating, signaling that the world is watching closely and confidence is beginning to erode. Persistent overspending sends a troubling signal to the world that the U.S. might one day resort to simply printing more money to pay its bills, a move that could unleash inflation and further weaken the dollar's value. As a result, global investors are now pricing in the risk of future fiscal irresponsibility, and the dollar is already feeling the impact, losing ground as confidence in America's financial stewardship wavers. The dollar's decline is more than theory. It's visible in investor behavior. As confidence fades, there's a global flight from dollar assets. Investors are selling U.S. stocks, bonds, and cash, creating a self-reinforcing cycle of decline. Gold, the ancient safe haven, is surging. Its price has soared in 2025 as investors seek protection from currency devaluation and inflation. Gold-backed funds and physical bullion are seeing record inflows. Central banks are joining in, countries like China and Russia are selling U.S. treasuries, buying gold, and diversifying into euros and yen. This strategic move reduces their exposure to U.S. policy risks. The psychological impact is huge. The dollar's role as the ultimate safe haven is under threat. In past crises, capital rushed into dollars. Now, it's fleeing. The reversal signals a fundamental re-evaluation of the dollar's place in the global system. As the dollar stumbles, the euro is surging. The euro-to-dollar rate has hit decade highs, reflecting renewed confidence in Europe. After years of crisis, the eurozone now boasts greater political cohesion and economic stability. The European Central Bank has held rates steady, making euros more attractive than dollars. The EU's move toward fiscal integration, including common bonds, has deepened its capital markets and provided a credible alternative to U.S. treasuries. While the U.S. turns inward, the EU is signing new trade deals and championing global cooperation. Investors and businesses are shifting capital to Europe, boosting the euro's strength. For the first time, there's a real alternative to the dollar for global trade and reserves. The euro's rise marks a historic challenge to dollar supremacy. The dollar's decline is accelerating central bank diversification. For decades, the dollar dominated global reserves, but now, central banks are reducing their exposure. Recent data shows a clear shift away from the dollar-centric model. The reasons are clear. Dollar volatility has caused losses, and U.S. sanctions have made countries wary of relying on the greenback. Central banks are increasing holdings of euros, yen, yuan, and gold. This isn't panic, it's a deliberate, strategic move. The dollar's share of global reserves is at its lowest in decades. As demand for dollars falls, the U.S. will face higher borrowing costs and lose its exorbitant privilege. Quiet decisions in central bank boardrooms are reshaping the global financial order and challenging America's economic power. The dollar's fall hits home. For Main Street, it means higher prices for imports, electronics, clothes, cars, and rising inflation that squeezes family budgets. Overseas travel is pricier too. For businesses, exporters benefit from a weaker dollar, but importers face higher costs. Some pass these on to consumers, fueling more inflation. Multinationals see foreign profits shrink when converted back to dollars. On Wall Street, volatility reigns. International investors are selling U.S. assets, pushing prices down. Banks with global exposure face currency losses. If global finance shifts to euros, New York's dominance is at risk. The Fed may be forced to raise rates to defend the dollar, risking recession. The government faces higher borrowing costs. The 2025 dollar crash shows how tightly America's prosperity is tied to its currency's global standing. Looking ahead, experts are split. Some dollar bulls argue the crash is temporary. America's dynamic economy, deep markets, and rule of law will restore confidence. They see no true alternative. The euro has its own issues, and the yuan isn't fully trusted. Others, the dollar bears, say the damage is lasting. Years of debt, political interference with the Fed, and unpredictable trade policy have eroded trust. Central banks are diversifying, and the euro is rising. The era of dollar dominance may be ending. A third view predicts a multipolar world. The dollar remains important but shares the stage with the euro and eventually the yuan. This would mean less US influence and more global instability. The choices made in Washington now will determine which future unfolds.